Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets buried in corporate filings. And let me tell you, COHU's latest report is a real gem if you like numbers that keep you guessing. Today, we're diving deep into COHU's quarterly report, looking at how they're doing financially. This report covers the period up to late June 2025. Think of it as a mid-year checkup for the company, giving us a peek at their financial health. Let's start by looking at the company's assets and liabilities. This is like taking a snapshot of everything the company owns and owes. Right now, as of June 28, 2025, COHU has about $164 million in cash and cash equivalents. That's down from about $26 million at the end of the previous year. It seems like they spent some money, which we'll explore as we go through the report. Now, something interesting here is their goodwill. This often represents the value of a company's brand and reputation beyond its physical assets, or what they paid for an acquisition that was more than the fair value of what they bought. COHU's goodwill has jumped significantly from $234 million at the end of last year to almost $290 we're well and to be going through how to reach $4 million as of June 2023. For our best big jump strongly suggests they made a major acquisition, and we'll get to that later. Looking at what the company owes in the short term, its current liabilities are around $100 million. That's up from about $85 million at the end of last year. This increase is mainly due to a jump in accounts payable, which is money owed to suppliers. When you subtract what a company owes from what it owns, you get stockholders' equity. For COHU, this is about $830 million as of this June. It's a bit lower than the $857 million they had at the end of last year, which makes sense given the increase in liabilities and the cash outflow we noted earlier. Now let's talk about how the company performed operationally. This is where we see their income and expenses. In the second quarter of 2025, COHU's net sales were about $107 million, a slight increase from about $104 million in the same period of 2024. For the first half of the year, sales were down a bit to $2,004 million last year. The cost to produce what they sell went up in the second quarter, costing them about $60 million compared to $57 million last year. This means their gross margin, which is what's left after you subtract the cost of goods sold from sales, took a hit. As a percentage of sales, their gross margin was 43.7% this quarter, down from 44.8% last year. They mentioned this was due to the mix of products they sold and some extra manufacturing costs as they moved operations overseas. They spent about $23 million on research and development in the second quarter, which is up from $21 million last year. This indicates they are still investing in new products, which is a good sign for long-term growth. Selling, general and administrative costs, or SG&A, went down from $32 million last year to about $29 million this year. They attribute this to cost controls and lower incentive pay, but also note that acquiring a new company added to these costs. They also booked about $1.2 million in restructuring charges this quarter, related to a plan to streamline their business. This is a common move when companies want to cut costs and improve efficiency. When you add up all those costs and compare them to sales, COHU reported an operating loss of about $17 million this quarter. That's similar to the $16 million loss they had last year, showing they are still working to turn a profit. And after accounting for interest and taxes, the bottom line shows a net loss of about $16.9 million for this second quarter. Last year, the net loss was around $15.8 million. So the company continues to operate at a loss, but the amount of loss is relatively stable. Now let's look at comprehensive loss. This includes that net loss we just talked about, but also adds in other changes in equity that didn't come from regular business operations like currency translation effects. In this section, you see a significant positive adjustment of over $13 million this quarter related to foreign currency translation. This means that due to currency movements, the value of their foreign assets and liabilities increased in dollar terms. Last year, this was a negative adjustment of about $3 million. For the first half of the year, the positive impact was even larger, around $19 million compared to a negative of $12 million. Last year, this was a negative adjustment of about $3 million. Last year, while they had a net loss, when you factor in these currency adjustments, their overall comprehensive loss for the quarter was about $4.8 million. That's better than the almost $18.5 million comprehensive loss they reported last year. Let's check out where the company's cash is going. This is the real test. Are they generating cash or burning through it? We already saw their net loss for the first half of the year was a little over $47 million. They added back about $26.5 million for depreciation and amortization, which are non-cash expenses, so that's a positive adjustment. They also added back over $11 million for share-based compensation, meaning they gave employees stock awards. Here it is, the big outflow we suspected from the goodwill jump. They spent nearly $35 million on acquiring Tignis. This acquisition is likely the main reason their cash balance decreased. Despite the net loss, COHU actually generated about $5.9 million from its operations in the first half of the year. This is positive as it means their core business activities are bringing in more cash than they are spending on immediate operational needs, even though that's a big drop from the negative cash flow from operations last year. They also invested about $13.6 million in property, plant, and equipment. This is for buying new machinery or upgrading facilities, which is necessary for future growth. Overall, their investing activities used about $34.7 million, mainly due to that Tignis acquisition. And in financing, they used about $1 million, mostly for repaying debt and buying back their own stock. So combining all these activities, their cash balance dropped by a significant $41 million in the first half of the year. Now, let's dive into some of the accounting policies which explain how they record their financial transactions. Let's look at their inventories. They have about $137 million in raw materials, work in process, and finished goods. This is down a bit from the $141 million at the end of last year. Their property, plant, and equipment, after accounting for depreciation, is valued at around $77 million. This is up slightly from the end of last year. COHU operates in one main segment, semiconductor test and NAMP. Inspection equipment, this means all their products and services fall under this one umbrella. They perform tests to see if their goodwill, which is that brand value we saw increase, has lost value. They do this by comparing the company's value to what's on their books. They haven't found any signs of loss of value in their goodwill lately, but they warn that if their stock price stumbles too much, they might have to take a big write-down, which would hurt their profits. They are also tracking their restructuring costs. In the first half of 2025, they've spent about $7.8 million on restructuring. This includes costs for employee severance and closing down certain operations to become more efficient. The company uses stock as part of its employee compensation. In the second quarter alone, they spent over $5 million on this, and for the first half of the year, it was over $11 million. For the second quarter, their basic loss per share was 36 cents. That's a bit worse than the 34-cent loss per share they reported for the same period last year. They had about 46.7 million shares outstanding on average during the quarter. Let's look at how they are financing themselves. As of June 28, 2025, they have about $18.3 million in total debt. This is quite a bit higher than the $8.8 million they owed at the end of last year. A big part of that increase comes from a revolving credit facility they took out in Malaysia for about $8.9 million. They also have some smaller term loans with Japanese banks totaling about $1.8 million. And then there are some construction loans related to their German operations, totaling about $6.8 million. We saw earlier they had restructuring charges. These are costs associated with closing facilities, laying off employees, or reorganizing operations. For the Poway manufacturing transition, they incurred about $1.2 million in the first half of 2025. Then there's the larger 2025 strategic restructuring. This program is designed to cut costs by consolidating operations in Switzerland and Germany and reducing headcount globally. For this, they've recognized about $6.6 million in charges so far this year. COHU holds short-term investments, mainly in debt securities. These are valued at around $45 million, and they're pretty careful about these investments, saying they only buy high-quality ones. They don't expect any major losses from these investments, even if interest rates go up. Most of their cash and short-term investments are considered level 1 or level 2 in terms of fair value. That means their value can be easily checked against market prices or similar observable data, which is good. They have plans like the 2005 Equity Incentive Plan and the Employee Stock Purchase Plan, which are ways to give employees stock options and shares. This is a common way to motivate employees by tying their success to the company's. They've awarded a lot of restricted stock units, RSUs, to employees. These are promises of future stock. About 1.3 million RSUs are still outstanding. They also grant performance stock units, PSUs, to top executives. The number of shares they actually get depends on how well the company performs, which is a smart way to link pay to results. COHU uses foreign currency forward contracts to handle the risks of currency fluctuations because they do business all over the world. This is smart risk management as it helps to protect them from unexpected losses due to exchange rate changes. They've also started hedging their net investments in foreign subsidiaries. This means they're trying to protect the value of their overseas operations from currency swings. COHU has a program to buy back its own stock. They still have about $22.8 million left authorized for repurchases. They bought back about 432,000 shares in the first half of 2025 for roughly $8.6 million. When it comes to taxes, COHU operates in many countries with different tax rates. They also have tax breaks in places like Malaysia and the Philippines. They mentioned they are currently under examination by tax authorities in several countries. As we noted, they operate in one segment, semiconductor test and inspection. Looking at where they sell their products, China and Taiwan are major markets, followed by the Philippines and then the United States. For the first 6 months of 2025, one customer represented 10% of their net sales. This tells us they have some key customers that are crucial for their revenue. Normally, having one major customer can be a risk, but they don't mention any significant issues with this customer. They have a lot of lease agreements for facilities and equipment. In June 2025, they gained access to a new corporate headquarters in San Diego, California, which they plan to move into in early 2026. This new lease will add a significant amount to their lease liabilities over the coming years. The company mentions they are involved in some legal proceedings and claims, but they don't expect these to have a major negative impact on their business. They provide warranties on their products, which is standard practice. As of June 2025, they had about $3.2 million set aside for future warranty claims. The management's discussion section talks about their business outlook. They are focusing on building a resilient business, getting new customers, and developing innovative products. They remain optimistic about the long term, especially with the growth of AI and their new product introductions. A key risk they highlight is the impact of changing US trade policies and tariffs. They specifically mention new tariffs and the potential for retaliation from other countries. This uncertainty could affect their product cost, demand, and overall financial performance. They are actively repurchasing their own stock, which can be a good sign that management believes the stock is undervalued. They still have $20.8 million available for this. Their directors and executives are using trading plans to buy and sell stock. This is a way for them to manage their personal finances while avoiding accusations of insider trading. One director also adopted a trading plan through a trust. So what's the story here? COHU is navigating a tough semiconductor market. Sales are flat and they're still losing money, though the loss per share is holding steady. The big news is their acquisition of Tignis, which significantly boosted their goodwill and cost them a good chunk of cash, leading to lower cash reserves. They're also spending more on R&D and restructuring to become more efficient, which is a necessary move in a competitive industry. The company is trying to manage its global operations and currency risks effectively. The ongoing trade policy uncertainty is a significant risk they're watching closely. While the company isn't currently risked there captively, the ongoing trade policy uncertainty is a significant risk they're watching closely. While the company isn't currently profitable, their investment in new products and their efforts to cut costs suggest a strategy focused on future recovery. Alright, that's our breakdown of COHU's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community in the description for more discussions like this. Thanks for watching. See you next time.